I'm Sean Scallon, and I'm one of the managing partners of Kingsgate Capital Partners, which is a leading boutique capital raising and fund marketing firm. We connect global and domestic best-in-class fund managers with allocators and influencers of capital in Australia, New Zealand, and the broader APAC region. Very excited today to kick off our Five by the Fire, which really is an attempt to connect those allocators and influencers of capital, starting off with our esteemed advisory board. And we have one of our advisory board members today in Nathan Peters, who will be interviewing one of our strategies today. And of course, Duncan Farley, who heads up and is co-portfolio manager of the event-driven credit fund. So with that, let's get into it.
Thanks, Sean. Duncan, good to be with you today.
Yeah. It's good to be with you, Nathan.
What was your path into your current role, and what do you find most interesting about it?
Well, it's certainly a long role. I mean, I started my career back in the 80s, so it's been a long path. And actually, in truth, and I'm not just saying this for the predominantly Australian audience that are listening to this, but some of you know I spent 3 years in Australia, and actually one of the most influential people that sort of set me on my path was one of my partners back then, who sadly no longer with us. And he taught me two key things. He was one of the first to introduce me to the concept of the glass half full. I mean, it's been widely used since, and glass half empty. And he was very keen that I, having had a path up to then focused on corporate recovery, started to think about the glass half full. And that's really important to what we do, because yes, there's a big emphasis on downside and working out sort of worst case scenarios on the investments we make, but we can't lose sight of the fact that when we buy into things, we need to have a path to actually exit. So thinking about what the value can be on the upside as well is key. So having that balanced view, empty and full, is absolutely key. He also gave me the sort of believe in myself, and actually told me that whatever career path I took, he was convinced I'd be successful at it. And that gave me the confidence when I returned to the UK nearly 27 years ago now, to switch across into the European high yield and distressed markets, which I've been focusing on ever since.
Great. No, it's good to hear you spent some time in Australia. I'm enjoying it very much. I wanted to just ask you about the fund, the event-driven credit strategy. What are the goals of the fund, and how has it achieved them so far? Now, I have my data here, and it's saying to me that the strategy is up over 78% net over the past 45 months. So well done. How did you do it?
Well, in terms of what the goal is, the goal as we sit down on a sort of January the 1st each year, is we as a team think we can generate a 15% return across the fund. We think we have the diversity of the strategies within the fund to do that. We think it's a realistic target, as you pointed out. We've managed to achieve that, certainly more than achieved that in the past 45 months. So I think we have a nice structure of the fund. It allows us the flexibility to do different types of investments along some of the same themes. But yeah, simply put, the target is get 15%, and if we don't do 15% of the year as a team, we're all extremely disappointed.
Got it. And so what would you say the focus is for the team in the investment landscape, and what do you believe gives your strategy an edge versus other players in the market?
Yes, so we're focused on debt, on credit markets. We're buying high yield bonds, we're buying levered loans, we're buying bank debt as a rule. Our focus is Europe. That's where we're based. That's where our edge is. There's a lot to do here. The size of that market is enormous, but we're particularly focused around the mid-market. So I'm talking about capital structures here, or balance sheets where you're between 100 and, let's say, 750 million, let's say US dollars for using a standard denominator. That's our sweet spot. That's where we can deploy sufficient capital to be so that we can have influence. We're very active in what we do. And I'm not saying that that part of the market isn't competitive. Of course it is, but it's not quite as crowded as maybe some of the other parts of the market, some of the bigger structures where you'd be up against some of the bigger funds. So we think that's a good sweet spot, and we think Europe is a big enough spot to be able to manage the funds that we currently and we hope to manage over the coming years.
Thanks. So you often, I mean, you mentioned the bottom-up sort of approach to how you invest, but you often also discuss macro headwinds in your supporting materials. So what's your approach in mitigating the potential effects of these macro headwinds on your portfolio?
Yeah, it's a good question, because obviously we do highlight that clearly in a down, let's say in a down market where there are sort of macro headwinds or sort of recession or whatever, however deep that recession is, that will create opportunities for us. There's no doubt about that. But we can't lose sight of the fact that that also is going to have an impact on the existing investments that we have. So it's very important for us as the portfolio managers to make sure that although typically on the fund we've got 40 investments, we want to try to make sure that they're all different. They've all got their own story and they're all diversified. And I think if you look at the performance of the fund over the years, you'll just see the real absence of correlation with every other asset class really does support the fact that we are taking 40 different, not bets, but if you want to call them that aren't too correlated. But to the extent that we feel that if we see that there are macro headwinds ahead, there are ways in which we can mitigate that risk by investing in certain instruments. But having a diversification in our underlying investments is the best way to mitigate. And of course, the other best way is to make sure, and I always say this, is to try and pay as low a price as you possibly can for the investment in the first place. If you're buying at the sort of the lowest possible point, then maybe with headwinds it takes a little longer to play out, but you shouldn't be losing money along the way. It might just take a little bit longer to generate the returns if you're relying on the general market or the general macro in order to get to that exit point.
Got it. So margin of safety here. I guess we don't have to guess really about how the fund would perform in difficult times. The fund was live during COVID and tough market conditions in 2022, when both equities and bonds were highly correlated and had negative years. So how did the strategy fare in those environments?
Yes, I mean, certainly for a couple of weeks, I mean, absolutely everything was down on the screen. So what did you need then at that point in time? You needed an experienced head, an experienced team to be able to navigate through that, to not panic and to recognize the opportunity set that was being presented. There were a lot of really good companies whose credit instruments, whose debt were trading at big discounts. And unless you took an unbelievably negative view on what the world was going to look like, then there were certainly some opportunities there. So we were very active. We were very busy. We were busy on the short side, but we were also very quick to take advantage of discounted debt and put new trades on. And in fact, at the end of the year in 2020, we were up over 11.5% on the year. Which was a testament to the fact that we were doing that we were particularly active. And then in 22 as well, I mean, which was a difficult year for bonds and equities across the board. We were up 17%, and that was really the fact that we homed in and focused on 2 or 3 key sectors where we had identified in the preceding years that there were lots of good opportunities, debt trading at deeply discounted prices, where we felt the underlying stories for those sectors, at least, even if maybe the general macro wasn't perfect, were definitely improving. And opportunistically bought in and started to crystallize during 21 and certainly during 22 and 23. So again, we were up 17% in 22, which was not necessarily a great year for other asset classes.
Really interesting. Thank you. And so how would you describe the current opportunity set, and why would now be a good time to invest?
I'm keen to point out to people that it is an evergreen strategy. There's always something happening. There's always something to do. But there's no doubt that what we've seen over the last preceding COVID a period of low rates. It's been very very easy to borrow at very low rates, and corporates have been dining out on cheap debt and taking advantage of that. Unfortunately, then as the sort of music has stopped for a lot of those companies, they haven't been able to improve their profitability post-COVID, and they're sitting there with too much debt, too much leverage, and at a cost that's not sustainable. So I often say to people, if people have heard me before, if your leverage is over 4 times and you're facing the prospect of having to pay over 10% for your debt, it's simply not going to work. And there are a lot of companies, both public and private, that are in that position. And that's our feeding ground for investments, and we expect this to be a multi-year cycle. This is not just we're not just going to see a spike, and perhaps as we did post GFC, we expect default rates and opportunity set to be 2 to 3 years out. So these are exciting times, always exciting times, but even more opportunity. And we only need 40 investments or thereabouts on the fund, so we think we've got plenty of a big pool in which to find the hopefully the best of the 40 that we need.
Duncan, this has been great. Thank you for your time today, and thanks everyone for listening.
Thank you.